Hi, me again. Time to have a little chat on the classified balance sheet. Right from the beginning, I'd like to let you know that you must classify balance sheets to have them be prepared in accordance with generally accepted accounting principles. They cannot be unclassified. We just haven't taught you how to classify them yet. As a matter of being too busy with other things. We have had other irons in the fire, wouldn't you say? I'd also like to ask you to spend some time on this concept. It's in the last part of your chapter. It's tested on the upcoming test and on the final exam. And just a little bit of work would add a lot of points. So give it some thought. Remember, a balance sheet represents a snapshot at a point in time. It is as of the close of business on a certain day. And we pass it to outsiders so that they can use it to assess our risk and our liquidity. It makes the balance sheet more understandable. The standard classifications are for assets: current assets, long-term assets, property, plant, equipment, and intangibles. In some books there could be other versions of that, but for our book that's what we'll use. And in liabilities, there are current liabilities, long-term liabilities or long-term debt, and owner's equity or stockholders' equity, or maybe even partner's equity if you happen to have those kind of entities. Here's a picture of a classified balance sheet as far as current asset, or as the asset side of things go. You can see we have our current assets, our long-term investments, property, plant, and equipment, and intangible assets. Under current assets is a category called short-term investments. Those are things that are readily marketable and will be turned into cash within a short period of time. That is why they are not down under long-term investments. Things in that category are understood to be held a little bit longer. Current assets are generally listed in their nearness to cash, which means cash, of course, would come first. So, total assets, $61,400, still needs to equal owners' liabilities and owner's equity. Let's move forward, though, and talk a little bit about what those might look like. We have our current liabilities, and your author has a convention of putting notes payable first and the rest of the liabilities put in the order of their maturity date or when they expect it to be paid. Then we have mortgage payable and notes payable. And owner's capital, again coming in at $61,400. So short-term liabilities are what's separated from long-term liabilities. Let's go back to how we classify things then. Back to the original classification. What's the difference between a current asset and a non-current asset? And again, those are current assets that a company expects to convert to cash or use or consume within 1 year or their operating cycle, whichever is longer. The operating cycle is the average time it takes for a business to purchase inventory and then collect cash from the customer. The reason that it's a year or operating cycle, whichever is longer, is by definition cash, inventory, and accounts receivable are current assets. Sometimes things get hung up in inventory for a while, maybe even a year or two if you're building a building or a ship or something. And inventory is always part of current assets, so it might make the operating cycle just longer than a year. Most businesses' operating cycle is shorter than a year. Think about a produce stand. It'd be very short from when they buy it to sell it and collect their cash. So current assets are things that will be consumed or convert to cash within a year, an operating cycle, whichever is longer. Long-term investments are things that we have invested in other businesses and that we think we will hold longer than that period of time. Here's a picture of somebody you'll recognize, Yahoo Inc. Their long-term investments are in marketable securities. Moving down, we've looked at current assets and long-term investments. Next item on the list was property, plant, and equipment. Things that live in this part of the balance sheet are there because they are used in operations. They're not inventory. They're not held for resale. The reason we own them is we're using them. They have long lives, and we depreciate them, and we show the net of their accumulated depreciation. That is shown with it or in the notes to the financial statements. And intangible assets, finally the last category, are things that we own that do not have a physical substance, like goodwill. You'll learn about that in future accounting classes. Customer lists, franchises, trademarks, things that have value to us, but that don't have physical existence. So we've looked at the asset side of things. Let's look at current liabilities. Those are obligations that a company has to pay within a year in operating cycle, whichever is longer. Another way to say that would be out of current assets, obligations that must be paid out of current assets. Your author likes to list notes first and then followed by accounts payable, and then list other things in the order of their maturity date. This section is usually listed in the order of its maturity date. We do a current asset and current liability comparison on a balance sheet to see if we think the company is liquid enough. Do they have enough current assets to pay their current liabilities as they can do? If current assets is $10,000 and current liabilities are $5,000, you're probably in pretty good shape. If current assets are $10,000 and current liabilities are $50,000, I think you need a line of credit. You are technically insolvent. Don't have enough money to pay your bills as they come due. Long-term liabilities are amounts that we expect to have to pay after that period of time, after an operating cycle. Here's a picture of Procter & Gamble's. They have lumped all their long-term debt into one category, and if you wanted to see what made that up, you'd have to look in the notes to the financial statements. Since Procter & Gamble is a corporation, they also have income taxes, and they have a deferred portion that's shown here. Let's move on then. Since we've looked at assets and liabilities, let's look at owner's equity. So far, we've been studying proprietorships, but there are partnerships and corporations as types of entities that we'll study in this book as well. Partnerships and corporations are studied in the next semester of accounting. Corporations don't have owners, they have stockholders, therefore it's called stockholders' equity, and they issue stock. So you can see what Nordstrom's stockholders' equity section looks like in this exhibit. Nice shoes. I would never wear those heels. Well, thank you for joining me, and make sure you spend a little time looking at that classified balance sheet. Bye for now.